Hello, and welcome to Money Matters TV. I'm Audrey Greenberg, co-founder of the Center for Breakthrough Medicines and Discovery Labs. And my co-host today is Mike Deaver from Brandywine Asset Management. Our guest today is Anthony Miles, an urban health and wellness real estate developer, as well as a private equity fund manager, a leading authority on urban land development, and a decorated veteran, thank you for your service, of the United States Navy Trident Nuclear Submarine Force. Mike, you've been in the investment business for a long time, and it seems there's a lot going on that's out of the ordinary. Historically low interest rates, increasing inflation. Are there two issues that we keep hearing about over and over? How is this really affecting investment for retirement, or really during retirement for that matter?
Yeah, it's a big issue right now, because historically people would start rolling money out of risky assets like stocks and into something that's a little more conservative like bonds, leading into retirement. And they would rely on income during retirement on bonds. And in the 1980s, when the bond bull market really took off, I had a friend, for example, he had sold a business, made a lot of money on that, and couldn't figure out what to do with his money. He just put it into U.S. Treasury bonds. Right. Over the next 12 years, they averaged about 18% per year annual growth rate just on Treasury bonds. Today, you get less than 2%.
Yeah, exactly.
So you really just can't do the same things today that you did then in retirement. And so things like a target date fund where they start moving money into bonds, I think they're actually riskier than they are conservative, because you end up with less money, and in retirement, you need to have that money.
Yeah. So is there a place for bonds given the yields that you're seeing?
Not a whole lot. I really think it's a negative ad, in a portfolio. So where people used to be able to do a 60-40 balanced portfolio, they consider it balanced with 60% stocks and 40% bonds. If you do that today, you're really looking at, we just did a white paper on this. You're looking at low single-digit returns on that. And with inflation heating up, you may actually end up with less money. I've got another friend, a larger investor, and he said he wants to just be conservative. He's leaving most of his money in cash. And what you don't see is the insidious nature of inflation, which is devaluing that. He's losing money. He's going to be losing money at his 10 basis points return he's getting every year. So he's locking in pretty much a guaranteed loss, because the Fed's told you they want inflation to be 2% or higher. So he's going to be losing money every year without thinking about it. So to me, that's the riskiest trade he can make, not the safest trade, because it's guaranteed loss.
Yeah. You mentioned that 60-40 split. Do you think portfolio diversification is really a good way to protect against, let's say, a bear market loss, or what would you do in terms of money diversification?
Okay, so what's interesting about that is if you do proper portfolio diversification, yes, I strong believer in that. I think you get more value, less risk by properly diversifying. And I wrote a book about it. I was fortunate; it was a bestseller in 2011 in the mutual fund category and on the Kindle. And I talk a lot about portfolio diversification in that, but diversifying across return drivers, not asset classes, which is what traditionally is taught. And the problem you have is that diversifying across asset classes, meaning small cap stock or large cap stocks, European stocks versus US, is that they all go up in sort of a non-correlated fashion, but when they drop, they all drop together. So you don't get that diversification value on the downside. I like to use the example. It's a little bit of a funny metaphor, but in one of my favorite movies, Butch Cassidy and the Sundance Kids, they take on, instead of being outlaws, they're going to take on a legitimate job, and they're acting as payroll guards for this gold mine. And they're coming down the hill to get the money for the gold mine, and they're looking all around trying to figure out where they're going to get attacked. And the guy that's with them, he's got like morons. I got morons. And I'm thinking, he got the smartest guys, no guns and robbers of anybody. And he goes, morons, nobody's going to rob us going down the mountain. We have no money going down the mountain. And that's the way I view protection with diversification. It provides no protection when the markets are going down. They all end up highly correlated, and you don't have that protection. So that's why 60-40 was better, because the bonds would generally go up in that. So people need to start getting a little more creative, looking at a little different opportunities than what's out there today, just to protect their portfolios.
Yeah, and speaking of protection and risk, how much risk should someone really take?
Right. So it depends on how you define it. So for example, the one investor I mentioned that said he wants to take no risk, so he's leaving it all in cash, is actually taking on a guaranteed risk. He's losing money every year to inflation. You've got, others that I had an investor in 1999 who had been with me for 15 years. And he said, I want to take my money out now. What we were doing was moderately risky stuff. But he'd done really well with it. He said, but I want to take it out and put it into something safe. I'm retiring. And I said, that's great. What do you think you're going to do? He said, well, I just want to put it in somewhere I can earn a steady 20% per year. And he turned it over to a broker who was doing tech stocks. And through 2.5 years later, he came back with $220,000 out of $600,000 he started with. So he took on a lot of risk because he felt he needed that to fund his retirement. Right. And the market's not going to give you what you need. It's just going to give you what's available. And so I feel like people need to target what that return is. They got to make sure they've got the money in there to hit that return using moderate assumptions. And it really gets down to saving as much as you can while you're earning. When you're in retirement, my argument would be you still want to hang on to that principle as best you can. And if you need more money, maybe you're not fully retired. Maybe you take on a part-time job, because the wrong thing to do is to increase your risk to try to get that return up, because almost certainly you're going to end up with less return over time.
Right. Well, there's certainly a lot of jobs out there for people to take right now. Seems like
that's true.
Yeah. So I was wondering, is there a place for crypto? What do you think about that?
So crypto is wild. I mean, it's one of those things where it's any market's only worth what people are willing to pay for it, but crypto especially so, because there's really no other use for it other than most of these, crypto that's out there, other than speculating and hope somebody comes along and buys it for a higher price than you paid for it. I view it a lot like the ultimate modern day chain letter. You put your dollar in and you send it out, and hopefully more and more people pick it up down the line, and you start getting some money back.
Right.
And so by limiting the supply, which is what most of these cryptocurrencies have done in their design, Bitcoin being the standout, example of that. By limiting supply, if you're able to convince more people to come in and buy it, that price will go up. But ultimately, there's a point where you've kind of got everybody in that's intended to be in it. I don't know where that point is. So there may very well be a good reason to be in crypto. To me, it's just more of a dice roll. But right now, the crypto market has over $2 trillion in value in it. The entire gold market, all the gold mined in history, is $9 trillion.
Oh, wow.
So you're looking at a market now that's starting to approach in value some reasonable percentage of what's been sort of the standard bearer for holding value. It scares me a little bit, certainly, because I think there's going to be a lot of people ultimately do lose a lot of money in it. Right now, you've minted millionaires and billionaires. So is there a place for it? You could do it, but you just have to understand there's no way to value it. You're just counting on someone else coming in after you did that has more enthusiasm to buy it than you had.
Supply and demand. Speaking of which, we do have a question from the audience. Robert Gooden of Philadelphia asks, Mike, what are some defensive sectors to buy in the market at this time?
Okay. So he's got maybe and I'm seeing this more and more with investors, more of a defensive attitude where they think, okay, the market's running up, pretty aggressively. I don't want to take on too much more risk there. We just put that out in our monthly report this morning, talking about some of the valuation measures that are out there today. The vast majority of them could be cut in half and still be overvalued. So things like the cyclically adjusted price earnings ratio that Robert Shiller has created, that's over twice its normal. The Q ratio, there's a number of these things. So it's not a bad idea to maybe be looking at something a little more protective. And my son asked me something similar to this. And what I recommended to him was a value, if you want to still be in something that provides some growth and equity exposure, especially a value stock fund. So something like the VTV from Vanguard ETF, or VV IAX from Vanguard as well, the mutual fund, because value stocks have been underperforming growth stocks for quite a while now, and that ratio is at pretty extremes. And my feeling is that even in a bad environment, you can still get some good returns out of the value funds, even if we have a bear market. And that held true in the 2000s, the early 2000s, when value really took off relative to growth.
Interesting. Okay, thanks for that, Mike.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
With that, we offer Anthony Miles a warm welcome to this week's episode of Money Matters. Once again, Anthony is an urban health and wellness real estate developer, private equity fund manager, and a leading authority on urban land development, as well as a decorated veteran of the U.S. Navy's Trident nuclear submarine force. Mike, it appears our guest, Anthony, really sits across the intersection of real estate and investment. And we'd love to hear more about you, Anthony. So if you could give us an introduction, and just knowing our topic today is how to create $1 million or more in retirement funds by investing in urban healthcare land development deals, starting with just $50,000 to $100,000. Anthony, tell us, our viewers, who you are, and give us a little introduction. Thanks.
Great. My name is Anthony Miles. I was born and raised in Philadelphia. I am a urban land developer, and I'm the #1 leading authority on urban land investing. Proud father of 2 children, Alexis and Ian. I served on board a nuclear Trident submarine, and I'm proud of that. And I spend my time helping people who are pushing toward retirement.
Very interesting. So tell us a little bit more about your backstory and how you got into what you're doing today.
Yeah, it was interesting. About 20 years ago, I had lunch with Robert Kiyosaki from Rich Dad, Poor Dad. And during that lunch, he said something profound to me. He said the reason why Black people don't become millionaires is they walk past the work to get to a job. So that kind of intrigued me. So I went down to the corner of Broad and Ridge Avenue in Philadelphia, and what I saw was thousands and thousands of people on their way to work. And then about 9:30, I see a bunch of people in trucks heading into the neighborhoods, doing real estate, doing multifamily, mixed-use property. So I quickly understood that really what he was talking about is all of the vacant land in these urban neighborhoods that are underutilized.
So that, I mean, that sounds like that was quite the turning point for you.
Yes.
Prior to that, what was your direction? How did you end up meeting with Robert in that luncheon?
Yeah, I was doing some consulting with a large church up in Brooklyn, New York, and all of Robert's advisors from his Rich Dad advisors were speakers at the event. And after the event was over, they were so impressed what me and my brother were doing that they invited us to come down to Scottsdale, Arizona to meet Robert personally.
Oh, that's great. So you got yourself positioned. It just wasn't happenstance. It wasn't luck.
No,
you
it was
created
by
the opportunity, and then when you heard the opportunity, you realized that you could seize on it.
Yeah, exactly.
And that's what differentiates entrepreneurs from so many other people, I believe. That's great.
I agree. Mm-hmm.
So what makes urban land investment strategy different as an accelerator in economic development?
Oh, it's interesting. Urban land development is the best of both worlds. You can make money and you could do social good. The first thing that makes it great as an accelerator are the yields. In the previous intro in the episode, you were talking about bonds and stocks and urban land investment. It's a growth strategy where you can generate anywhere from 25 to 31% annually. The other part of it is that the demand that we focus on, which is healthcare, which is housing for older seniors 55 plus, as well as community farmers markets and clinics. And then the third part is the social good to it, is that many of these neighborhoods that we go into, that we invest in, along with our clients, are either food deserts, health and wellness deserts, healthcare deserts. So you're making money, but you're also doing social good.
Let me understand that a little bit then. When you're doing it, what is it what's the specific product you're creating? Is it a planned sort of mixed use community in an urban environment that includes residential and retail and some medical education? What's it look like?
Yeah, so I'm glad you asked that, Mike. So we have three different investment types. The first investment type is a multifamily. And what we do is we look for vacant development sites that are at least a half an acre, where we can go to the city and get zoning approval for at least 50 senior housing units or more. So that's investment type A. The second investment type B is the same size site. It's either half an acre or more, where we're able to do a mixed use project where we do senior housing and also a community farmers market on the ground floor level. Investment type C is also a half an acre or more, where we're able to do another mixed use project, which is senior housing with a medical clinic on the first floor. So those are our three verticals that we focus on.
Mm-hmm. And these are in opportunity zones, so there's some tax advantages as well, correct?
Yes, they're in opportunity zones. And the key thing is we're able to force appreciate the value of the assets with the zoning and use approvals. So we're buying land at below market value in underserved neighborhoods, and then we're basically going in and getting the approvals. And then after the approvals, we exponentially increase the value of that.
Mm.
So what's your basic average day? What do you wake up and do, and how long does it go for you as an entrepreneur? I'm guessing forever, but more specifically, what is it you're doing each day?
Yeah, each day, I'm doing multiple things. One, we have a huge project that our group have in the Tioga section of Philadelphia. It's a 139 acre project that we master plan the whole neighborhood. So we're working on that. Two, we're also force appreciating our own projects for our internal group's retirement. And then three, we're buying other sites for clients to come in and co-invest with us. So as you can see, I have an exciting day every day.
Yeah. What are some of your? Sorry, go ahead, Mike.
No, yeah, I was that term force appreciating. What was the?
Yes, force appreciating.
What does that mean? Force appreciate.
What it means is if, let's say you have a half-acre site, and the half-acre site is zoned for single family. As is, that site could be potentially worth $200,000. That same half-acre site where we go in and we design up either A, B, or C, which are investment type. And let's say that site, we put a medical clinic on the ground floor and 80 senior housing units on that site. It's as is 200,000. After we get the zoning approval, that project will appraise for $4.2 million.
Yeah, that's great.
Yeah. And what are some of the accomplishments that you're most proud of with urban land or otherwise?
I think what I'm really proud of is that we created this blueprint, and we used it primarily for ourselves for the last 17 years. Initially, we used it for our lifestyle dreams. We were able to buy land, force appreciate the value, and then use it to fund our own dream homes with basically cash. And now we're transitioning now to our retirement, and more importantly, helping other people accelerate their retirement. What I'm most proud about is what we're doing up near the Temple Health Sciences campus, where we have this 139-acre project that we're doing. It's the largest master plan development in the history of Philadelphia by an Afro-American development group.
Nice.
When it's done, it'll be 2,000 housing units, a medical clinic, a 19,000 square foot community farmers market, 300 senior housing units, a indoor vertical farm, and a host of other amenities. So we're really excited about that.
That's fantastic.
That's when's that going to be completed? Or what's the timeline, I guess, for phasing that into completion?
The community said they wanted us to get it all done or make a major impact within the next 48 months. So we were blessed in that we took 32 of the projects through zoning approval prior to the pandemic. And all of those projects that I'm mentioning, our group invested our own money to buy those parcels. So we're heavily invested, and we have 100% success rate with zoning approval in the city of Philadelphia.
Is that right?
Yes.
That's amazing. Yeah, so it sounds like you've got the community on your side, you have the city on your side. Usually these projects are held up because somebody's opposing. It sounds like, if anything, these people are pushing you. You've got more of a tailwind than a headwind, certainly, which is great.
Yeah. The thing is that what we do differently than most developers is we only design projects that the communities actually want. So if you give them what they want, they will inherently approve it, right?
Right.
So we only design projects that the community asks for.
That's great. Now you touched on a little bit, but this was for you guys, for lifestyle, for you and your partners, and now you're talking about preparing and settling into retirement. What's that look like for you? What does retirement mean to an entrepreneur that's been as active as you've been? Yeah,
we're myself, my brother, my daughter, and our partner Doris Harris. Is 4 of us. We're all 36 months away from reaching our retirement goals. For me specifically, retirement will be 0 personal debt, which I don't have any debt now, so I've already achieved that. Also, I'm looking to build another new home, a 7,700 square foot home. I plan to build completely debt-free on that one. And also, my goal is to have $50,000 a month passive income in retirement, and then also a $3 million endowment fund for youth track and field, which is one of my passions.
That's great. I've been a high school track coach, a jumps coach. So
nice.
I certainly appreciate that.
So what's
40%.
possible? Yeah, what's possible for our viewers? How can our viewers get a 7,700 square foot house and 50,000 a month in retirement and all that wonderful? And how can they learn more about what you're doing if they want to do some additional investigation?
Absolutely. So the beautiful thing about these blueprints is it's kind of multifaceted. Starting with 50 to 100K, our program is not it's a kind of like it's a 10-year program. And in year 5 through 10 is where you see the most growth in all of, and you can understand that with the compounding ratio of the money. But they can achieve, they can basically pay off all their debt with the proceeds from urban land investment. They can build a new dream home. They can also pay for college for their children and grandchildren. And they also can start the process of building $10 million or more in generational wealth. We always tell people to start early as possible. So the more time you have, the more of the acceleration is going to be. So if anybody's interested in learning more, they can reach me at Anthony B. Miles at gmail.com or abmiles@gmail.com.
Okay, great.
So how do you anticipate if you've got people investing, you still got new projects going, but you're also moving into retirement? What's the succession plan? Who takes on what you're doing when you're retired?
Yeah,
or is retirement sort of a term that
my version of retirement is just simply me reaching all of my financial goals. It doesn't mean I'm going to stop doing what I'm doing. It means that I have reached all of my goals that I set out on my dream board for the lifestyle of the way I want to live. And the second part of your question is my daughter, Alexis, has been with us for the last 9 years. So Alexis is more than capable of running this when I finally decide that I want to cut my time down.
Yeah, that's great.
That's good to have a succession plan, certainly when it's family. And it's nice to have family that are passionate about what you do. And I think it's easy to be passionate about what you do when you're doing something that is, double bottom line, sort of good for our community as well as an economic benefit. Well, it's been very nice having you. Thank you so much for joining us, Anthony. It's a pleasure hearing your story and what you're up to here in Philadelphia, which is a great place to live and sounds like a great place to invest. Next week, our guest on Money Matters will be Shelley O'Donovan. She's CEO of Authentic Influence Group. Thank you for watching Money Matters TV, and we'll see you next time. Have a good day.